Bitcoin might be having its first major pullback in a while, and you are thinking about buying some more or even buying for the first time. With so much new excitement around, investors are now wondering whether they should buy Bitcoin directly or invest through a Bitcoin ETF. This is also because major Bitcoin ETFs were recently approved. Both options provide exposure to Bitcoin, but there are some key differences to consider. In this video, let's look at the pros and cons of investing in Bitcoin directly versus investing in the Bitcoin ETFs. We'll look at factors like ownership, security, fees, tax implications, and more. By the end of it, you'll have a better understanding of which option may be more suitable for you. Let's begin. Let's start with the pros of buying Bitcoin directly. By buying Bitcoin directly, you will have true ownership and control over your Bitcoin through self-custody in your own digital wallet. This aligns with Bitcoin's core principle of being a decentralized peer-to-peer electronic cash system free from third-party intermediaries like banks, institutions, or governments. You become the true and sole owner of your digital money, not just a beneficiary. This also means that you have alignment with the Bitcoin ethos. Holding Bitcoin directly allows you to fully embrace Bitcoin's founding ideology. Basically, there will be no centralized financial institutions and you will have achieved monetary self-sovereignty. You will then be participating in this decentralized ecosystem as originally envisioned by Satoshi Nakamoto. Again, these two will help you attain no counterparty risk. By self-custodying your Bitcoin, you are not exposed to any counterparty risks of relying on exchanges, custodians, or other centralized entities to safeguard your holdings. There is no third party that can censor, freeze, or confiscate your Bitcoin based on their policies and regulations. Your money will be truly yours. By holding Bitcoin directly, you can take full advantage of its capabilities as originally envisioned, being pseudonymous, immutable, censorship resistant, and operating 24/7 without any downtime on third-party control. You can even participate more directly in the Bitcoin network by running a full node, engaging in true peer-to-peer transactions, and exploring emerging technologies like the Lightning Network. You unlock Bitcoin's full potential rather than just price exposure. You never know when you'll need it. Then there's also potentially lower fees. When you buy Bitcoin directly, you will have a one-time fee, but if you own the ETF, there'll be recurring fees. Holding your own Bitcoin puts you at the forefront of this new financial revolution. You will truly be your own bank. While we are not super early adopters anymore, it's still fairly early, and we get to participate in this massive shift towards monetary freedom. Of course, it's not all easy going, with some cons of buying Bitcoin directly. First, you have the technical responsibility of self-custody. Self-custody comes with great responsibility. You are alone accountable for the security of your Bitcoin holdings. This requires significant technical knowledge around using hardware wallets, properly securing private keys, implementing multi-signature setups, and maintaining robust backups. The burden is truly on you and there's no third-party custodian. Even a minor mistake like losing your private keys means permanently and irreversibly losing access to your Bitcoin. Unlike traditional finance, there's no customer support and no company to reach out to. The technical learning curve is quite steep, but that is the price you pay for monetary freedom. Next up, we have limited functionality of Bitcoin. While empowering, holding Bitcoin currently has limited functionality beyond being a store of value and medium of exchange. You cannot take advantage of more complex financial use cases like earning interest, using as collateral, or accessing derivative products. Its current use cases are limited beyond buying and holding and hedging against inflation. For a lot of people, that reason is itself enough, and a lot of others are just speculating anyway. Then we also have to talk about tax complexities. There are complex tax implications when holding Bitcoin directly, as most jurisdictions view every single buy and sell transaction as a taxable event for capital gains purposes. Buying and selling Bitcoin might require you to carefully track your transactions. This needs to be done to be tax compliant. You must maintain flawless records for tax reasons. However, there are applications that can help you achieve this. Finally, we have to talk about the security risks. Beyond the technical responsibility of self-custody, holding large amounts of Bitcoin also opens you up to potential security risks from hackers, thieves, and scammers trying to gain access to your holdings. You must take precautions like maintaining operational security, never ever sharing your wallet details anywhere, and potentially even taking steps to store your private key offline in a safe environment. The security burden is actually quite significant. So that's all about buying Bitcoin directly. What's up with the Bitcoin ETFs? Again, starting with the pros of Bitcoin ETFs. First, simplicity and accessibility. The biggest advantage of Bitcoin ETFs is how easy it is to access, especially for retail investors. These funds basically hold Bitcoin as an underlying asset and you can access it just like stocks. All you need to do is go to your brokerage account, find the right ETF and buy it. There's absolutely no need to deal with the technical complexities of self-custody or using any of the many crypto exchanges. Next pro is having access to professional management. Again, with the Bitcoin ETF, you don't need to worry about self-custody or storing your Bitcoin. Behind the scenes, the fund manager takes care of all the custody and trading that's required. These are also regulated financial products that must follow strict rules around auditing, insurance requirements, and proper safekeeping of the underlying Bitcoin holdings by professional custodians. Next, with the Bitcoin ETFs, you can also get tax advantages. A major benefit of the Bitcoin ETF is the ability to hold them in tax-sheltered accounts like IRAs, 401ks, TFSAs, RRSPs, and other registered retirement accounts. This allows for tax-free or tax-deferred growth, which you cannot achieve with directly buying Bitcoin. With direct Bitcoin holdings, investors miss out on this opportunity. Most self-directed retirement accounts do not allow direct cryptocurrency investments due to regulatory restrictions. I would also say that diversification is a pro. By this I mean that you can invest in the Bitcoin ETF while still maintaining diversification within your existing portfolio. It just makes it easier to visualize and track. Finally, another big advantage is regulatory protections. As regulated public investment vehicles, Bitcoin ETFs must comply with strict requirements around disclosures, reporting, auditing, and other investor protection enforced by financial authorities. This provides more transparency and oversight compared to the unregulated world of directly buying Bitcoin from private exchanges or parties. These follow the same established rules as they do in the TradeFi world to safeguard investors. Okay, these sound great, but what are the cons of the Bitcoin ETFs? First, as you might have guessed, its lack of true ownership. The biggest philosophical drawback of the Bitcoin ETFs is that you don't truly own the underlying asset. You are simply holding a security that gives you access to the price movements of Bitcoin. All of the core principles we discussed that make Bitcoin unique, like true decentralization, self-custody, and censorship resistance, are compromised by relying on a third-party custodian like the ETF issuer to hold the actual Bitcoin. Which leads us to the next problem, that is you get counterparty risk. By investing in a Bitcoin ETF, you are exposed to the counterparty risk of the issuing provider and whichever custodian they use to store the underlying Bitcoin. While incredibly small, there is some risk of mismanagement, especially if something majorly goes wrong in the world, especially when Bitcoin was created for risky times. The next thing to consider is trading limitations. Bitcoin ETFs are limited to the traditional trading hours of whatever exchange they are listed on, unlike the 24/7 global markets for trading actual Bitcoin. This is quite self-explanatory. If you need access to the 24/7 markets, buy actual Bitcoin. Next point is fee drag on returns. You'll have to pay management fees to the ETF issuers that'll eat into your returns over time. Fees for Bitcoin ETFs can range from 0.2 to 2% annually. These can compound significantly over time, which will result in losses for you. And finally, holding Bitcoin ETFs has limited functionality. While it's easy to hold the ETFs, it does not give you access to Bitcoin's full potential. This includes being able to use Bitcoin for cheap, fast transactions on the Lightning Network, running a full node, engaging in true peer-to-peer transactions, and tapping into the emerging DeFi applications. So make sure you consider the full capabilities of Bitcoin when deciding. Now that we have looked at the pros and cons of Bitcoin and Bitcoin ETFs, how do we decide? Let's look at some key factors you need to consider at a personal level. By the way, if you're enjoying the video so far, hit like and consider subscribing to spread the knowledge. So coming to the key factors. Factor 1. Investment goals. Mainly price exposure versus true ownership. You need to decide whether you truly want to hold one of the world's hardest assets or just want exposure to the price. Again, purchasing Bitcoin directly means you truly hold the asset, aligning with Bitcoin's core principles, completely free from intermediaries such as ETF issuers like BlackRock. The second factor is risk tolerance, volatility, security, and counterparty. Firstly, both Bitcoin and Bitcoin ETFs are exposed to the inherent volatility of this asset class. However, self-custody of Bitcoin carries additional security risks if not properly implemented, like losing private keys. ETFs, on the other hand, carry counterparty risk of relying on the fund issuer to properly secure and safeguard the underlying Bitcoin holdings on your behalf. The third factor is technical abilities, that is managing self-custody. The reason I have mentioned this point so many times throughout this video is because you truly need to understand how important it is to learn self-custody. Buying Bitcoin directly requires technical knowledge to properly store and secure the cryptocurrency using best practices like hardware wallets. You will also have to learn about managing private keys and maybe learning about multi-sigs as well. While ETFs, on the other hand, is just like holding any other stock. The final factor I want to mention is your tax situation. Direct Bitcoin holdings face taxation on every buy-sell transaction, creating accounting complexities. On the other hand, ETFs can potentially be held in tax-advantaged accounts like IRAs, 401ks, TFSAs, RRSPs, etc. This can lead to massive gains, completely tax-free in certain cases. In conclusion, as you might have guessed, there is no one-size-fits-all answer when it comes to buying Bitcoin versus Bitcoin ETFs. The ideal choice depends on carefully evaluating your specific investment goals, risk tolerance, technical abilities, tax situation, and philosophical alignment with Bitcoin's core ethos of self custody and disintermediation. Your location and trust in government institutions is also a relevant point. Those living under authoritarian or approaching authoritarian regimes must prioritize Bitcoin's censorship resistance properties and favor direct ownership. So far, I have not bought any Bitcoin ETFs, but I do intend to hold them in my tax sheltered accounts. This will let me take advantage of the price movements without the hassle of taxes. So, of course, you can mix it up as well. For a lot of us, having a balanced approach by using both the investment vehicles is probably the most optimal situation. Make sure you decide carefully. I'll be back next week with a new video. Till then, keep learning and stay on top of your finances. Until next time.